There is no topic in accounting as important as the income statement. It's probably the most important document that everybody cares about. If you are interested in a firm, whether you are a banker, investor, tax official, supplier, customer, the main thing you really care about is firm performance. Everybody cares about firm performance. So the income statement is the document. Let us see what it is. We have in front of us the income statement of Apple for the year 2021. What we see at the top is the sales figure. That would be $365 billion. And then the numbers underneath it are the expenses. So at the top, it is always what Apple makes by selling. And underneath it is all their expenses. The bottom line is the net income. It is what they have made for the year 2021. As you can see, the net income of Apple is $94.6 billion. That's a lot of profits. That simply is a super awesome performance. Apple is among the few rare companies where the net income per year is around the $100 billion mark. No wonder they are almost a $3 trillion company. If I talk about it in percentage terms and consider that their net sales of $365 billion is the 100%, then their net income, the bottom line, is 25.88%. It is not only that their sales of Apple are so high, their efficiency in converting sales to income is also very high at the same time. The efficiency of converting sales to income is not surprising. They are very popular. People love their products, and because of that, Apple is able to charge very high prices. Let me go next and explain to you the mechanics of the income statement. So what is an income statement, and what is it used for? The income statement is the summary of financial performance during a given period. For the case of Apple, in the slide before, it was performance for the year 2021. At the top, always, revenue is an increase in net assets from providing goods and services to customers. It is obvious that when you sell, and when you sell at a premium, your assets increase. You buy something at 100 and sell it for 150. The selling process increases the revenues. Expense is a decrease in net assets from providing these goods and services to customers. See, when you sell, it is not for free. You have expenses, whether it is the store, warehouse, factory, delivery van, employees, R&D, marketing. Running a business is costly, and you have to exhaust your assets to support the business. You need to understand that we do not record revenues and expenses using cash. In big corporations and in medium-sized businesses, everything works on a credit system. You buy and you pay later. You sell and they pay you in a few months. The process is called accrual accounting. Now that you are learning accounting in the big leagues, you need to forget the cash system. You learned when you were younger. You record revenues when you sell, not when you get the cash. You record expenses when employees work for you, not when you pay them their salaries. In other words, if your IT programmer works for the month of March, which is now, and you pay her in the first week of April, you record the wages expense in March when she works, not when you pay her, which is the month after. Although the main blocks of the income statement are from revenues and expenses, we also have secondary activities that are not related to main business, which is selling inventory. So if you are Apple, your main business is selling iPhones, iPads, iWatches. However, sometimes you sell a factory, a machine, a delivery truck, or a retail store. These do not go under revenues, which is the top line, because you are not selling inventory. These auxiliary activities go under other income. So to summarize, net income is composed of 4 items: revenues minus expenses, plus gains from auxiliary non-core transactions, minus losses from other non-core transactions. Here you have in front of you, to the right, a standard basic format of an income statement that starts with sales at the top, and then all the various expense items with the bottom line, which is net income. You should always remember the income statement measures performance and does not measure cash in and cash out. The income statement is based on accrual accounting, which essentially is based on a transaction system that is normally done on credit. Sales are the proceeds the company generates from selling goods and or services to its customers. In the case of Apple, it is both goods and services. Goods is going to be iPhones, iPads, and services will be like Apple TV and the App Store. Gross sales are simply the number of units sold multiplied by their average sales price. Net sales includes allowances, deductions, and discounts. So if some people are buying bulk and you give discounts, obviously the net sales is less. Some people return some of their goods because they change their minds. Some, at the end of the day, Apple simply records the sales on a net basis. Let us look at some examples. This is extracted from Apple's 2021 10K, which is the official filing with the US government. You see down there, sales, which is $365.8 billion, is made of 5 components: iPhones, Macs, iPads, wearables, and finally services that include both Apple TV and the App Store, among others. Apple puts a dollar amount for each of these categories, the biggest category being iPhones, at $191.9 billion, roughly a bit more than the 50% of the total. At the end of the day, Apple was, and still remains, for the last 12 years, a one-product company, the iPhone.